Let's dive into the exciting world of career opportunities for women over 40. Midlife is a time of transformation, and what better way to embrace it than by pursuing a new career path or job? With a whopping 72% of women aged 50 to 54 employed as of February 2022, the opportunities are not just knocking, but practically breaking down the door. It's like a green light for women in the workplace. So, if you're finding yourself in the fabulous 40s or the fabulous 50s and itching for a change, don't worry because we've got the inside scoop on the top three careers that are not only welcoming, but tailored perfectly for women over 40. From real estate to education and to the financial sector, the options are as vast as they are exciting. Now, we know that stepping into a new career space when you've got a few more candles on your birthday cake can be a tad challenging, especially when it comes to those gaps in your resume, assuming you have them. But fear not, because we've done the research and certain careers just fit like a glove for this demographic. Starting off my countdown of the top three careers for women over 40, we have a profession that's all about location, location, location. The ever thriving world of real estate. Did you know that the median age of a real estate agent is a fabulous 54? And guess what? More than 60% of those diving into this market are fearless, trailblazing women. Real estate licenses won't break the bank either. You can snag one without emptying your wallet. Online courses make it a breeze, and licensing exams are more than wallet friendly than a shopping spree, typically costing less than $500. But that's not all. Ladies, in real estate, you got the freedom to choose your style of work and even the potential of earning big bucks in huge population areas or by working with those high net worth clients. All those rich people you've been connecting with over the years and high middle class people can become your clients. It's like stepping onto the red carpet of career changes. Our runner-up in this exciting countdown bring us to the heart of care, the nursing profession. Now brace yourself for this fact. The nursing field is booming at a rate that makes other careers look like they're standing still. With opportunities galore, women over 50 can embark on a journey to become registered nurses in just 2 to 3 years. Talk about a swift transition. And the cherry on top, advancement is right around the corner when you decide to earn advanced certifications and degrees. By 2026, nurse practitioners are set to take the lead in growth, with projections 5 times faster than the average, according to the Bureau of Labor Statistics. Nursing is not just about a profession, it's a passport to a brighter future. Drum roll, please. It's time to unveil the champion of our countdown. It's the ultimate career path for women over 40. Counseling. In a world where emotional well-being takes the spotlight, the demand for counselors and therapists is skyrocketing. As more public and community institutions offers these services, women age 50 and beyond can step in and make a huge difference. To unlock this incredible career, a master's degree in your chosen area of specialization is the key. Whether it's substance abuse, marriage and family, or children, there's a path for everyone. And yes, there's a bit of a hurdle. Passing a licensing exam is huge. But remember, the view from the top is always worth the climb. So there you have it, the top three careers for women over 40 that promise new beginnings, exciting challenges, and opportunities aplenty. real estate, nursing, and counseling, each offering a unique journey, all waiting to be embraced. And remember that life doesn't come with an expiration date, and neither do your dreams. So get out there and show the world that age is just a number on your way to conquering the career ladder. And bravo to all the incredible women out there making their mark in the world and reaching those new stars. Luke Centrone is a seasoned senior reverse mortgage loan officer with an impressive 27-year tenure in the mortgage industry. He currently works for the Reverse One division of Cross Country Mortgage. Luke is an avid fisherman, a man of faith, devoted husband and father, and his journey has been marked by resilience and gratitude, having received a life-changing heart transplant, which ignited his mission to give back and make a positive impact on the lives of those around him. Known for his unwavering dedication to helping others, Luke is a true advocate for seniors seeking financial solutions. Luke's commitment to honesty and transparency is reflected in his approach as he educates seniors about reverse mortgage products. His approach empowers seniors to make informed decisions and helps them unlock financial tools for themselves and their families. Thank you so much for joining us today, Luke.
It's my pleasure, Sunita. Thank you for having me.
So tell me, when does reverse mortgage make sense? And please give a simple definition of it for those who are not familiar with reverse mortgage.
Absolutely. First off, you don't run to a reverse mortgage, you walk to it. It's an education. You have to take the time out to vet it. I take the time out to vet it with my clients, walk them through the product, their particular scenario, to see if it makes sense. If it does make sense, wonderful. We'll take the time out, get it done, get it closed, move forward. If it doesn't make sense, I will tell my client, this is not the right product for you. You should look into something else. Again, we have to take the time out to vet the client's needs, whether or not the reverse mortgage makes sense. In my opinion, anytime you add a reverse mortgage to a financial plan, it will always increase the probability of success. You're either eliminating a mortgage payment, or if you own your home free and clear, you're tapping into basically turning an illiquid asset into a liquid asset and turning it. You're tapping into a percentage of the home's value based on your age. So at the qualifying age of 62, a client's able to access at today's numbers of roughly about 33% of the home's equity due to the fact that rates are where they are at this time. The trade-off at this time is interest rates are so high. This is the one time in a borrower's lifetime where you're actually going to root for interest rates to go up, specifically in a free and clear scenario when you own your home free and clear. Say if I'm able to open up, I'll use myself as an example. As you mentioned, I'm a heart transplant patient. I'm not going to qualify for long-term health care. When I turn 62, my house will be paid off. I should be able to open up roughly about a $250,000 line of credit, roughly. I'm going to opt and choose what's called our max growth strategy, the highest possible interest rate I can get. You start out with a little less cash, but again, I'm not going to touch the line of credit. Now, keep in mind, a reverse mortgage line of credit grows over time. Unlike a standard HELOC from a bank, if you took out a $100,000 HELOC and a $100,000 HECM, home equity conversion mortgage, it's the technical name for a reverse mortgage, side by side, that HELOC, that 100 grand, will remain 100 grand the entire time you have access to that line of credit. Whereas on the HECM side, the reverse mortgage side, that $100,000 based on today's rates are growing at roughly 8.6%. So over time, that 100 grand will continue to compound and grow as long as you're not accessing it. That money will continue to compound and grow, and then will turn into a large pool of tax-free cash, where in my case, my $250,000 will be growing at, let's say, 8.6% over the course of 20 years. Whether it's myself or my wife, we should have access to over $1 million tax-free dollars to pull from for our long-term healthcare needs. It's a very powerful product, but again, it's an education. You should walk to it, Sit down, have it with your financial planner, sit down with me. We'll walk you through it and help you to understand whether or not it's right for you. There's a tool that we use, Anita. We call it our optimizer spreadsheet, where it used to be that all we had was our illustration or our quote and our amortization schedule and a really good educational explanation of how the product works. We've taken it a step further and provided a client a visual of what the reverse mortgage line of credit can do side by side next to a mortgage that they possibly have, that they have right now. I have an example I'd like to share with you. Is that possible?
Yes.
Basically, we take our illustration, our quote, and take all that information and move it over to our spreadsheet. In this example, we have a regular $800,000 mortgage, or valued home rather, with a 6.92% interest rate, with a $100,000 loan balance. Over the course of 30 years, making their payment at $1,156. Over the course of 30 years, they'll make those payments, locking that money, that equity, back up into their home. At a 4% appreciation rate over time, at $800,000, the home's value will increase, and then 30 years out, the home estimated value of $2.5 million in value. But again, all locked up in your home. On the reverse mortgage side, with an $800,000 home, client at age of 67 will qualify for $283,200. Closing costs are roughly around $20,000. The reverse mortgage has an insurance piece that I'm going to touch on in a moment, hence the higher cost for the reverse mortgage. Matter of fact, I'm going to deal with the cons of a reverse mortgage right now. There's a lot of misconceptions that are out there about reverse mortgages. There are two cons with a reverse mortgage. The fact that it's a negative amortizing loan. If you choose not to make payments, those payments still build up and accrue, just like a conventional mortgage does, except those payments get tacked onto the ending balance of the loan and come due when you either sell the home, if you're out of the home for more than a 12-month consecutive period, and then finally when the last surviving spouse passes away. At that time, the home will pass to the heirs, just like with a conventional mortgage. If there's a conventional mortgage on the home, the estate will have to pay that back. Same scenario here. Another big misconception is I must hear it at least 3 times a week. Isn't that the mortgage that they take your house? No, it's not the case. The house remains in your name. So when you pass away, the house will pass to your heirs, just like with a conventional mortgage. You have up to a year to decide, in this case, with a reverse. You have up to a year to decide whether or not you want to keep it via refinancing or paying it back any way you can, or simply sell the home, pay back the difference, and the difference in the equity of the value will go to the heirs. The insurance piece I was talking about, Sunita, the reverse mortgage has two key features that the insurance covers. The fact that it is a that it's a non-recourse loan, that you'll never owe more than the home is worth, and that regardless of the value of the home, your line of credit is in full force. What does that mean? I'm going to use an example. Let's say you have a $500,000 home with a $300,000 line of credit in a place like Flint, Michigan, where we now have lead in the water. The house is now worth $100,000, but I still have that $300,000 line of credit in place. I choose to pull that $300,000 out, put it in my checking account, sell the house with a fair market value of $100,000. At that point, the FHA pooled risk insurance fund, where in this case, the part of the closing cost, $16,000, was funneled into the FHA pooled risk insurance fund that ensured the fact that you would never owe more than the home is worth, and that regardless of that value, that line of credit is in full force. That $300,000, I walk away with scot-free due to the fact that I paid that insurance up front. I'm going to take it a step further, Sunita, showing the power of the insurance. I'm going to depreciate this property by 4%. With a $100,000 balance. So this is the same scenario that you have on the left-hand side, $800,000 home with a $100,000 mortgage balance, with a 4% appreciation value and 67-year-old. $800,000 value, 8.6% interest rate, 8.6% credit line growth rate. So remember, your reverse mortgage line of credit grows over time. So that, and at inception, your line of credit, rather, let's put this back. At inception, you have a $100,000 loan balance and your closing costs. So you're going to have $120,000 630 will be your loan balance. You have a home value in blue of 800, 120,630 is your loan balance. You have a line of credit of 162,570. Untouched, if you choose not to make payments over time, that loan balance will increase. 30 years out, you'll owe 1.5 million. But at the same time, that line of credit you have in place, if you choose not to touch it, it will compound and grow. 30 years out, you'll have 2.1 million tax-free dollars to pull from for whatever reason you need. To touch back on the insurance piece, if let's say, God forbid, we had another housing crash in 2008, and the house, for whatever reason, depreciated by 4%. I want you to focus on year 30. The only reason why I want you to focus on that, it shows the greatest impact. I want to do that again. Your house is now worth $235,000 and change. You have a loan balance of 1.5 million. You have a line of credit of $2.1 million. I get a phone call from my doctor. I have 60 days. Please get your affairs in order. I can choose to take out that 2.1 million, hand it to my child. I pass away. She does a deed in lieu, walks away without having to pay a thing due to the fact that the FHA Pooled Risk Insurance Fund kicked in, alleviating my heir of any burden whatsoever. Hence the higher cost with a reverse mortgage and the purpose of that insurance. So yes, I don't care how big your portfolio is. You see a large price tag or $20,000, $30,000 price tag, you're going to ask why. This helps a client to understand the reason why the insurance is in place. Very important piece.
Yeah, especially these days with all the natural disasters.
Correct. This is basically what my financial planner partners call a buffer asset. Mm-hmm. You know, on top of their portfolio, you will put this in place, allow this to compound and grow into a tax-free pool of cash where they could pull from on down markets, maybe to mitigate sequence of return risk. You can use the proceeds to, let's say, on a Roth IRA tax conversion, you can actually use the tax-free proceeds to pay the taxes on that. There's a lot of different things you could utilize the product for. Matter of fact, in this scenario, we could actually show a client, for instance, let's say this client had legacy concerns, because that's really another concern with reverse mortgages. Because if you choose not to make payments, and if you're concerned with what you're going to leave behind, it could cut into that. But with a reverse mortgage, the easiest way to explain a reverse mortgage, it's really similar to, it's just like a conventional mortgage, except it gives you the ability to make or not make payments. If you wanted to make payments, you absolutely could. So in this case, we could show this client making the same payment for a 5-year period. So we're showing them making a 10-year, that payment for a 10-year period, paying down that debt. After 10 years, that debt is paid off. Here, we'll make that same payment. Remember, we have $2.1 million. Let's refresh that. But making that same payment for a 5-year period, you now have 2.86 million as opposed to 2.1. By making the same payment you were comfortable making for a 10-year period for a 5-year period, you've increased your line of credit significantly.
Okay, quick question, because not everyone has a home that's valued at $1 million. Not a lot. The average people, $2 million. What is the minimum home value that you can have to get a reverse mortgage, and what age?
62 is the qualifying age. I've done reverse mortgages for 100-year-old clients. There's no limit in regards to the age. There's no discrimination at all there. Not at all.
Okay.
The only qualifying factors for a reverse mortgage, you have to show that you have enough income coming in to cover your expenses, property taxes, homeowners insurance, revolving debt, car payments. As long as you have enough income coming in, there's no issues. We only look back 2 years on a client. If there's any issues in regards to if a client was late paying their taxes and insurance in the past 2 years, there are ramifications in regards to that. But for the most part, the qualifying factors have been really shored up over the past few years, past 10 years rather. In 2014 and 2015 is really where in my opinion, the reverse mortgage became a bona fide financial planning tool. In 2014, it used to be if I was 62 and my wife was 55, was known as what's called a non-borrowing spouse. So I'm the borrower, she's 55. She would have to come off title at that time. So if I passed away, she would have to either refinance the home or sell it. So a lot of people were losing their homes because of that. So to keep that from happening, they brought in what's called the non-borrowing spouse provision. So if I pass away, my wife would still be allowed to live in the home for the rest of her life. The only difference there is if there was a line of credit in place, she wouldn't have access to it because she's not a borrower. But when she does turn 62, she could take out a reverse mortgage of her own and tap into that equity at that point.
Okay. And what's the minimum home value?
I'd say about 50,000.
Oh, wow. So
Yeah, I
that,
mean, you could go a little lower, but it's not really worth it. You can
yeah.
do it if it's a benefit for someone. We can't say no to an application. If
Okay.
someone wants to apply, obviously I'll tell them if it doesn't make sense or not, but we have to move forward with that application.
Okay.
The second provision in 2015, another big change was financial assessment. It
Mm.
used to be that all you had to do to qualify for this loan was own your home as your primary residence. And by the way, that is number one. Another factor is the home has to be your primary residence. It can't be a second home or vacation home. It has to be the home you live in.
So,
The
okay.
second, Mhm.
So since because my thought is that most people who get a reverse mortgage, maybe they can't afford to pay the mortgage anymore. They hit hard times regarding their income. Maybe it's retirement, Social Security isn't covering everything, bills that are coming in. So if that person's unable to really pay their mortgage, I mean, is it that they have to sign up for the mortgage before they get into financial difficulties? I mean, how do you,
Well,
how,
it's a great question. Reverse mortgage used to be considered the mortgage of last resort, where
yeah.
a lot of people were utilizing, and this is actually a good segue into what I was about to say. People were utilizing a reverse mortgage as a Band-Aid loan many years ago, where they still couldn't afford to pay the property taxes, homeowners insurance, homeowners association dues, what have you, but utilized a reverse mortgage to bail themselves out. Because it used to be all you had to do to qualify for this was be 62 years old or older and live in the home as your primary residence. That was it. So what was happening was, again, people were utilizing it as a Band-Aid loan and still not being able to afford it. So they were getting foreclosed on because they couldn't pay their taxes.
Mm.
So to keep that from happening, and they got a lot of bad press because, hey, nobody wants to foreclose on grandma and grandpa. No, that's not right. So to keep that from happening, they brought in what's called financial assessment. So now you have to actually show that you could afford to live there. You could afford to pay your taxes, insurance, revolving debt, and whatnot. And that those conversations could be difficult sometimes because sometimes it gets to a point where you have to be really blunt and honest with someone. Maybe it might be time to right size into something smaller, something more affordable, where you could utilize a reverse mortgage to do that as well. You could utilize a reverse mortgage to right size it to something smaller, using departure home proceeds to buy that house. So that you could use reverse mortgage in the purchase scenario. But the financial assessment was really solid in shoring up also the FHA insurance fund from keeping foreclosures from taking place. So it shored up the product. It helped solidify the product, in my opinion. The non-borrowing spouse piece, in my opinion, was huge. Having the peace of mind that God forbid something happens to me, my spouse is okay.
Yeah. And I agree that reverse mortgages did have a really bad reputation years ago because my parents considered it at one time. And I spoke to a friend of mine who was in financial planning, and he immediately was like, no, tell them no. And I just went with that, honestly. He's like, you don't want them to lose their house. So I remember that time. So it's
And
great.
there was times where, if not used correctly, you could get yourself in trouble. Hence the education.
Mhm.
The education. But then the two pieces that they brought in, the non-borrowing spouse provision and the financial assessment piece, shored up the product. And then what I've been doing for the past 6 years is I've been working directly with financial planners, helping them from becoming that non-believer that you just spoke about, turning that non-believer into a believer, showing them the optimizer, how it can be utilized, taking it, an extra step further. Like we could even show draws over time where we could actually break out inside of the financial planner's software, showing them that maybe in year 10, we turn on the faucet for a 10-year period. They need $12,000 a year of income. And in year 20, we show a long-term healthcare event where they have to fund $150,000 for a 5-year period.
I love that because then your home truly becomes an investment for the days when you really need it. And I like that that comes into the educational piece when you tie it in with a financial planner as well. That just gives it an overall different outlook and sense of peace about it.
Correct. And it's really, you have to take your time, walk through and learn it. This takes time to understand. And I take my client's hand, I hold up their hand, walk them through this, make sure they understand the mechanics of the reverse mortgage, long-term ramifications, and whether or not it's right for them. If it is, wonderful, we'll take care of it for you. But if it's not, at least we've taken the time to vet it to see if it is right for you.
Wonderful. So, of course, every scenario is different. So, if a potential client is interested, do you have like a free consultation? How would they reach you? That way, that person can speak to you about their situation, their home value, everything, and find out and learn from you and find out if this is the best path.
Yeah, you could actually, yeah, absolutely. You could email me at luke.centrone@ccm.com, or you could call me directly at 914-494-8319. Think of it as a simple conversation. We're going to discuss your needs, what's important, whether or not this is right for you. We are going to go over your budget. We're going to go over everything. We're going to take a deep dive to see whether or not this is right for you. And if it is right, we'll take care of it for you.
Great. And are you able to work with clients in any state, or are there
Yes.
limitations?
I'm licensed in 16 different states, but I have colleagues. If we have to assist another client, we could always pass it off to a colleague who is licensed in that state.
Perfect. And you probably have a pool of financial planners as well.
I do. I actually canvass probably 1,000 financial planners over the course of a year, just trying to stay in front of them and be of service. To be an avenue that if they have a client that we can help, we're here to help. Please reach out. We'll walk you through it, help them understand it, see what kind of an impact it will have on that particular plan's probability of success.
Wow.
One of my favorite lines is, anytime you add a reverse mortgage to a financial plan, you're always going to improve the probability of success. Again, you're either eliminating a mortgage payment or you're adding cash via the line of credit to, like with a financial planner, you're adding cash to a cash flow system. What does that do for a financial planner? It allows you to maintain and manage that client's money for a longer period of time.
Yeah.
And it creates referrals for financial planners as well. You're providing an avenue of tax-free proceeds, growing guaranteed tax-free proceeds to a client. You're going to come out smelling like roses.
Yeah, and being able to take care of those medical bills, because I think even with Medicare, you still have to pay 20 or 30%. So ladies, definitely reach out to Luke, get educated. He's not going to try to force your hand. You make the educated decision, you and your husband, or you alone, whichever your marriage situation is, just to put yourself in a better financial place during this retirement process. It's another phase, it's another transition, but make it a peaceful one because you've worked hard all of those years. Make your house work for you. Thank you, Luke.
It's my pleasure, Sunita. Thank you so much.